Dave, briefly, tell us more about this new China ETF. It launched last week. I mean, this seems to be based on the same principle as the Mag 7 ETF was based on a year and a half ago. But give us a brief summary of what that's about.
Yeah, so the China Dragons ETF, the ticker is DRAG, D-R-A-G, is focused just on 9 companies. And these are the companies that we identified as having similar characteristics to the Magnificent stocks in the US. And so by that I mean not just that they're large and liquid, but they have high earnings growth, high revenue growth, moats around their businesses. And what we believe, like we've seen in the US, is a winner-take-all environment, whether that's AI, cloud computing, growth of the consumer. Names like Alibaba, names like Baidu, Tencent, Pinduoduo exhibit those characteristics, and that's why them and only them are in the China Dragons.
Okay. Jason, you also run a China ETF. I want you to explain a little bit about Rayliant's investment methodology. This is the first time Jason's been on ETF Edge, folks, so I want him to explain your methodology briefly. And for those who do want to invest in China, what should they be buying? Explain this ETF to us.
Thanks, Bob. So, what Dave just pointed out in his ETF, there are a lot of names that are listed in the US or listed in Hong Kong. My ETF, RACI, it's only the onshore shares, meaning these are stocks that global investors, Americans, can't just buy listed on the New York Stock Exchange. So these are the local shares, local names that you would have to be a local Chinese person to buy easily, or you have to register what is called a kind of a cross-border, a QFII quota, Stock Connect to buy these shares. Okay, so these are the onshore shares. And generally, the onshore shares paint a very different story. When you look at what's traded onshore in China, tech is only about 11%. The other 90% would be in consumer, would be in white appliances makers, online, offline retailers. And so it paints a very different picture because China is sort of in a different part of its growth curve, right? Technology is important, but a lot of the higher growth stocks are actually people who sell water, people who run restaurant chains. Often they actually have a higher growth than even many of the tech names. And so we're trying to help investors get access to these names that are less familiar. There's very little research, at least outside of China. And they may represent what is more of a thematic, in the moment trade inside China that is not known to US investors.
Yeah, so I want to put up the list of what's in this ETF because it's interesting. The list is very diverse. Kwaichao Mutai, that's the famous liquor maker, right? That's like the biggest liquor manufacturer in China, right? Kwaichao.
Absolutely, yeah. Mutai is, of course, the luxury alcohol in China, and it's about $400 a bottle. And when the economy is starting to kick into gears, it tends to be like a leading indicator when people start to consume these luxury alcohols because they're hosting big corporate parties, they're going out to dine. And so this is a great indicator of the economy turning around.
Right. And Ping An, of course, is a big insurance company. They bought stuff in the United States, too, a while ago, a number of years ago, right? Famously, right? Did they buy the Waldorf Astoria? Who owned
Ping? Yes, so Ping An is a big, it might be Ping An, one of its related subsidiaries. It's the biggest insurance company in China, heavily exposed to real estate in China. And so it's a way to play the real estate turnaround, given the big government stimulus to stabilize the real estate sector.
So this is two different approaches here. I mean, Dave is basically tech companies that tend to list here in the United States too, and you have like A shares that are mainland China based. It's really sort of two different approaches. I guess the average viewer is sitting here saying, okay, I'm convinced I should put 5% of my portfolio in China. These are two completely different approaches to it, really. I'm just asking you. You both notice this? A viewer would notice this, right?
Yeah, no, but I think what's interesting here is that even though we're saying in some ways what could be viewed as opposites, right? So Roundhill is advocating and creating an ETF that provides precision exposures to the market leaders. Jason's approach is focused on local Chinese stocks and sort of a different growth curve. What we're both saying, though, is that perhaps the broad-based exposures that folks have thought of for China, whether it's the largest ETFs or whether it's even some newer technology-focused China ETFs, may not be the right way going forward. So I totally agree that approaches are either more active, more selective, and I would put drag in that camp as well, just taking a different spin on it. And to me, again, because of all the question marks that we talked about with China, uncertainty that is going forward, I don't think we can just rely on broad-based indices, whether to have exposure to Shanghai or Shenzhen listed companies or not anymore.
Right, and Jason, I can already smell the emails from people who are saying, well, the problem with owning China A shares is it's not really a real capitalist market. It's not really a stock market the way we understand it, because the viewers will say, I know people will email me, the government essentially controls these state-owned enterprises. Is that correct? Can you explain what a golden share is? I mean, people often message me that the government has golden shares, which meaning they have the ability to actually control ultimately what goes on in these companies. Explain how involved the government is in running state-owned enterprises, and what is a golden share?
Absolutely, Bob. So first of all, inside China, I would say 50% by market cap, right? It's not 50% by name, but 50% by market cap. It means some of the biggest listed companies are state-owned enterprises. Then there are often state-owned banks, state-owned insurance companies, big state-owned power and utility. Those are not super exciting, and generally in an active portfolio that I manage, Dave would agree, we'll have low exposures to state-owned enterprises because, as Dave, as you mentioned, the government in these state-owned enterprises have the golden shares, meaning they might float shares and U.S. investors could buy them and you'll receive dividends, but the government has more voting power than you do. But that's not very unique, right? In the U.S., I think if you think about Meta, Facebook, and Mark Zuckerberg has golden shares in a way that he, while being a very minority shareholder, has the majority of control. This is true in China with these golden shares. It just means when it's a big state-owned enterprise, the government, even though it might be a 20% shareholder, would have the majority control right. Now, again, we're quite careful in terms of oftentimes avoiding or be extra cautious with state-owned enterprises because, again, sometimes they're just big dividend payers, but there's not a lot of growth because of the government intervention.
So your point is, so for example, you might have a company where the government owns 20% of the float by market capitalization, but they have 70% of the voting power. Is that your point? You seem to be drawing an analogy. It's kind of like Meta and Mark Zuckerberg. I'm not entirely sure that's the same thing necessarily, though, or it's necessarily that benign. Is this true, by the way, of private, so-called private companies? For example, Alibaba or some other company that is not a government-owned enterprise?
So in the case of Alibaba, interestingly, Jack Ma has the golden share, meaning I think Jack Ma is 4% of the company, but he has majority control. So it's similar from a corporate governance, and if you're concerned about that, yes, it's the same concern. But Bob, you are right in the sense, like, you would believe Jack Ma to be, highly competent, so you might want him to have the golden shares and have the control right. Or you might say, well, Beijing, is Beijing really the best person to be running, even if it's a big state-owned enterprise? Should Beijing have, 90%, 80% of basically the controlling votes?
Right. And Jason, this is coming at a time, what I find interesting, when many ETF providers are launching emerging markets ETF ex-China. They're excluding China from the emerging markets. And we can put up one here, EMXC. And I know you've told me it is a mistake for global investors to exclude China, regardless of the politics. Very briefly explain why it is a mistake to exclude China.
Yeah, so our shop also has a EM X out China. Now, to do X China, I would say that's not about eliminating China out of your portfolio. To do a EM X China is because China is so large that you don't want your EM to just be China, right? If you just keep China in there, China sometimes is 30%, sometimes 50%, depending on how it's performing. So X out China gives you flexibility to overweight or underweight China, just like you take US out of the global portfolio, otherwise US would dominate the global portfolio and you wouldn't be able to see Japan or UK. The reason why it's a mistake to take out China is, similar to what Dave has mentioned, China is so big as an economy, right? It contributes, I think, to 20% of global GDP growth, right? It is almost the size of the US in terms of the sheer size of the GDP. And it's on a different phase in its growth trajectory. And its per capita GDP is still growing quite rapidly. You want to participate in that, right? You want to participate in their growth, which is very uncorrelated with the US growth. And that's great for your portfolio. It's another way of buying different demographics. different production function, different risk premium. And then I think as a careful investor, if you're well diversified, it's a great way to build a better portfolio.
Right. Participating in growth sounds good, Dave, but it's not the same as participating in stock market gains. China has had growth, but not stock market gains. That's what drives investors a little bit crazy. And Dave, this is a good moment, I think, to remind everyone that China investing is very confusing because you're dealing with really almost three different kinds of investments here. You got mainland China, you got Hong Kong, and you have China stocks that trade outside of China, like Alibaba, that trades in the US and now also in Hong Kong. And there's different ETFs for all of them. And folks, we've gone over this many times. This is one of the reasons ETF Edge exists. You can sometimes get very different outcomes depending on what parts of China's investing landscape that you are looking at. So, for example, the iShares large cap at the FXI, which is the oldest one, it's 20 years old, those are all Hong Kong stocks. There's the MCHI, which is the broadest one that's out there. That's Hong Kong, China mainland, and U.S. stocks. KWEB, which is China internet stocks, includes U.S. listed shares. Dave, I guess the point here, I'm putting up a screen here, I don't know if you can see it, is you can get a lot of different outcomes depending on which China ETF that you're investing in. Now, the one you've chosen here that you're using is essentially 9 large stocks. But can you address that sort of difficulty of trying to figure out what kind of ETFs or what kind of China you want to invest in?
Yeah, no, you're absolutely right. And so we've seen the expansion of EMX China. We've now seen the expansion of a multitude of approaches to accessing China, and all with different nuances. And again, that was one of the theses of us launching Drag, was that even though there's already a lot of options out there, what was missing was the precision to just the largest leading companies. And so for an investor, for really any ETF, but especially when you're picking a sector or industry in the US, or in the case of China, you really need to know what you own, do your homework, understand what the outcomes may be. Don't necessarily be rear view looking, because really most of them have had challenging performance in the grand scheme of things, especially relative to the US. And going forward, again, if we believe in the stimulus, believe in an opportunity to access an undervalued China, many of them actually may be attractive solutions for you. But for the case of our ETF Drag, you're just going to have exposure to 5 to 6 stocks, 9 right now, that are the market leaders. Many of them are actually listed in the U.S. or have very liquid ADRs in the U.S.